This lesson, part of the Wyckoff series, we're going to look at structures. So there are a whole host of Wyckoff structures. There are a couple that you will have seen very commonly, the basic accumulation and distribution schematics, but Wyckoff theory goes so much more beyond that, and we're going to dig into that right now. It's impossible for two structures to be the same, right? So most people who struggle at the start with Wyckoff theory get hung up because they're trying to find exactly this on their chart. But it's literally impossible for the market to ever look the same twice. You don't have the same traders, you don't have the same level of interest, you don't have the same volume, you don't have the same external events, everything's different. So while they might look similar, they're never going to be the exact same. And why I believe Wyckoff is a superior theory to any other price action is it deals with phases and events rather than being rigid about just the candlesticks on a chart. Markets are living and breathing. They're full of a wide range of people who have different opinions and different financial power. It's silly to suggest that a structure should play out just because you can see it on a chart. The number one thing to watch for with Wyckoff is what I call the shift of control. Now, he called it change of character, but we've already used that term for something different in the market structure lessons. So let's stick with shift of control. Right? I think shift of control is actually an easier one to understand anyway. Because very literally, if we look here, zoom in on this accumulation, your fundamental, what matters, what you're looking for are these two shifts of control. They are the only things you need to profitably trade a Wyckoff schematic. Because what do you need? You need confirmation that the downtrend has ended and that we've shifted into a range. That's shift of control number one, from trend to range. That encompasses selling climax, automatic reaction, and the secondary test. You then have shift of control number two, where the balance of power moves from being neutral in the range into the hands of bulls, which is how you start a new trend. That will encompass your trending through the range with your last point of supplies, your show of strength, jumping the creek, breaking out, and your backup, your retest, to then continue into the new trend on the bull side. Same for a distribution. The first thing you want to look for in a distribution is your first shift of control, where it moves from trending to ranging, where it moves from uptrend to sideways consolidation, beginning with your buying climax, encompassing your AR, finishing with your secondary test. After that, when we shift into phase B, your shift of control is confirmed. Now what you do is you simply wait for your next shift of control, number two, where we go from ranging to trending by trending through the range, by showing weakness, by retesting and selling off. This part in the middle is where most people fuck it all up, right? The times that you need to take action are 1, after you find the SOC and it's confirmed, you then know I can trade this as a range, so range trading is valid, but for trend trading, I need to wait for SOC 2. That's a very simple rule that everyone should apply to their trading. Once you confirm SOC 1, you say, okay, I'm no longer trading with the previous trend, I am now trading in range. That means entries and exits are defined. I do not try and catch massive moves. And I wait for SOC number 2, at which point I start to trade again. That is extremely powerful for those who grasp the concept, because there are only two ways to trade: trend following or mean reversion. Understanding the shifts of control gives you the key to trade both of those. So we've covered the shift of control. Now, I'm just going to quickly show two more schematics, and I'll actually compare them to these ones. So we've covered the shift of control, but I want to look at the different types of accumulation and distribution that you can have, because they don't all look the same, as I mentioned. And for horizontal ones, which are the ones on the screen, you can see these. So in accumulation, you can see it, the classic one, we have your selling climax, you have a secondary test as a show of weakness, and then you have a spring, the very common shakeout, spring, and then you pump. Or you could have accumulation number 2, like is here, where you don't get the spring as in sweeping the lows going below, but in fact it holds and then pushes up. They're the two common ways that you can see an accumulation occur in a horizontal form. Distribution, this is the classic. You have a buying climax, you have an upthrust, and then you have a UTAD, upthrust after distribution, the typical 3 peaks, peak 1, peak 2, peak 3. It then sells off, classic. Distribution number 2, you just get 2 peaks, 1, 2, and you have your last point of supply, your failure to go higher, and it rolls over and goes down. Those of you looking might see that this one also looks quite like head and shoulders or the over-under pattern, all very valid. So we've now covered horizontal structures, but Wyckoff doesn't stop there, and accumulation and distribution doesn't stop there either. It can come in different forms. I want to now talk about sloping structures, which actually occur more frequently and are harder to spot for the untrained eye, but that offers a lot of edge and is why they're so effective. If you can learn how these work, you can get a material edge on your rivals. So let's talk about those and also the subtle differences in each of them.